It's late, you're half asleep, scrolling your phone, and you open that app to check your retirement account. You see a little green number and you get that quiet, comforting thought. Okay, I'm doing this right. For millions of us, that comfort comes from one very specific assumption. We've been taught to expect our investments to grow by about 10% every single year, building our entire future around that single mathematical pace. But recently, the bank that other banks rely on, Goldman Sachs, published a report for the upcoming decade, and the number they calculated quietly dismantles that whole plan. They aren't predicting 10%. They are forecasting 3% a year. And once you subtract the rising cost of everyday goods, inflation, that 3% is basically zero. This chart shows exactly what that looks like. Instead of that steady, aggressive climb upwards that we're all counting on to fund our eventual freedom, the growth just goes completely flat. Planning your life around a 10% return, but actually getting 3%, is the financial equivalent of packing for a cross-country road trip, only to realize your car is strapped to a treadmill. You are moving, you are sweating, but you are going absolutely nowhere. That slow, stagnant crawl does far more damage to a retirement plan than a sudden market crash, precisely because it is so quiet. Nobody panics, nobody adjusts. You just slowly run out of time. Goldman Sachs arrived at that number by looking at the simplest concept in shopping, the price tag. Every investment has a starting cost, and that cost determines how much room is left for you to actually make a profit. There is a basic rule when you buy a slice of a business. If you pay a high price for it on day one, your odds of making a profit down the road are much lower. You are essentially prepaying for the growth before it even happens. Even seasoned investors like Warren Buffett use specific logic to see if the market has become too expensive for its own good. We can see the problem by comparing the total value of all stocks to the actual size of the US economy, or by checking the price of a single share against the profits those companies actually make. Right now, both of those measurements show we are paying prices that have rarely been seen in history. The 3% forecast is the mathematical result of paying top dollar today for growth that hasn't happened yet. But high prices are only half the problem. There is a second, sneakier issue hiding right inside the accounts of people who think they are doing everything perfectly. This visual represents what most of us think we own. When you buy a standard S&P 500 index fund, the pitch is safety in numbers. You are buying a tiny slice of 500 different businesses, spreading your risk far and wide. If one company struggles, the other 493 carry the weight. It's supposed to be a massive, reliable safety net. Except, over the last few years, a handful of giants have completely taken over that grid. Because of a shift in the tech sector, just 7 companies, the so-called Magnificent Seven, now make up roughly a third of that entire index. You aren't truly spread across 500 businesses anymore. You are heavily exposed to a few companies that have grown so large, they now dominate the entire market landscape. This shift follows a surge in demand for the specialized computer chips used in artificial intelligence. Buying a safe index fund today has quietly become a highly concentrated bet on a handful of Silicon Valley CEOs. Let's look at what happens if this expensive, top-heavy market actually flatlines for a decade. To do that, we need to imagine 2 different investors, Catherine, who is 28, and Daniel, who is 57. For young Catherine, a slow decade is a financial gift. She is working, saving, and quietly collecting shares at lower prices for a recovery that is decades away. Look at this diagram showing a stagnant market. While the line goes nowhere, Catherine is steadily scooping up shares on sale month after month. But Daniel doesn't have 30 years. He is right at the finish line. When he retires, he stops buying shares and has to start selling them to pay for groceries and electricity. Looking at that same stagnant chart, Daniel's reality is different. He is cashing out pieces of his life savings while prices are stuck at the bottom. Once those shares are sold to pay the bills, they are permanently gone. Even if the market eventually bounces back, Daniel's portfolio won't, because he had to consume the very assets that were supposed to drive his growth. A flat decade specifically punishes people who are forced to withdraw their money at the worst possible time. If you're feeling that knot in your stomach, remember that panic selling everything and retreating to cash is the exact wrong response. That move often guarantees you'll miss the eventual recovery and buy back in far too late. The actual fix depends on where you are in life. For Daniel, he needs to move some of his savings out of that concentrated tech basket and into safer options, like bonds or broader global stocks. This creates a sturdy buffer. When that sluggish decade arrives, he can pay his living expenses using those safe assets. He buys himself time, ensuring he never has to sell his stocks at a discount. And Catherine simply needs to drop the expectation of massive yearly returns. She needs to ignore the noise, keep her habit of saving, and keep buying consistently while prices are low. The biggest threat to your financial future isn't a sudden crash on the news. It's the quiet gap between the growth you assume and the reality you fail to prepare for.